Space. Lupin is the biggest gainer today, up about 5 odd percent, while Dr. Reddy's is up about 1.5%. And this month in general has been very good for Pharma. So after seeing a big surge in early trade, the Pharma stocks are off their session highs but still trending with strength. A case in point is Lupin, as I mentioned. Anmol, Ganjoo, the Vice President, Institutional Equities at JM Financial, joins us now to talk about that. Anmol, hi, good afternoon. You know, many of these stocks like Lupin and Sun Pharma went through a rough patch post their earnings and post the profit warning for something like Sun Pharma, but bounced back quite well. So let's take them one by one. Lupin is the biggest gainer today. How are you positioned on that stock now?
Yeah, hi. Good afternoon and thanks for having me here. See, what has happened in the aftermath of earnings is that it's not been a rosy picture for all the names. What has happened though is that you've seen a sharp currency depreciation, and which is supportive for the earning estimates for most of these companies. That's point number one. Point number two is that there have been certain specific concerns related to plant issues of a lot of these companies, and as and when we receive news flow suggesting that the problems might not be as severe as initially thought, then obviously there is some relief coming into play as far as the stock price performance is concerned. That being said, I think we have to be cognizant that these stocks are no longer cheap, and US performance, which was blockbuster last year on the back of certain meaningful product launches, it's not a dynamic which is going to repeat itself year after year. So net-net, we are positioned constructively on the sector. We also highlight that it's time to be discriminating as far as individual stock price performances are concerned. Lupin obviously does remain a favorite of ours, given its impeccable execution track record. But as far as earnings for 17 are concerned, we think there is still some optimism built around the pipeline, etc., which needs to be tempered down. But outside of that, I think the execution track record has been brilliant, and we see no reason for that to change.
Okay, Anmol, hi, good afternoon. Let's talk about the second tier stocks, the non-index large cap space. Your Glenmark and Aurobindo Pharma, Divi's Labs, all of them have done remarkably well over the last few days. Is there anything that you like in this space?
So we don't cover a lot of these names, but obviously have views around them. See, the broad sectoral tailwinds which help the likes of Sun and Lupin are also in play for the second tier, so to speak. But this does continue to be a fairly bottoms-up approach. We think that Glenmark has benefited given some visibility on its pipeline. But we think clearly that 56, 57 rupees is the best case EPS they can do in FY17, implying it trading at higher than its 5-year average. So obviously a lot of optimism built there. Torrent Pharma is something which we like and remain extremely constructive on. That is predicated given the Abilify windfall they've had, the cash they're accumulating as a consequence of that, and successful integration of Elder. So while the broad tailwinds which are present in this sector help across the cap curve, but as always is the case, some are going to be better positioned to take advantage of them. We think Torrent and Ipca, because of a host of other reasons, also valuation, comfort, etc., continue to be our favorites in this space. Divi's again is something which is going to be a beneficiary of currency depreciation, so there are upside risks to FY17 96, 97 rupee consensus earning estimates. So that's again something we continue to like, but not very constructive on market at this point in time.
Okay, so those are a couple of your mid-cap picks. From the large-cap space, another stock that you've liked is Dr. Reddy's, and that one has been, one of the big gainers this year. It's already given about 35% returns. But my question to you is more with regards to valuations, because after the run-up, Dr. Reddy's is now trading at about 23 times FY17 earnings. Would you be at any point concerned about valuations, or do you think because the growth trajectory is so good, one should continue backing a stock like Dr. Reddy's?
Of course, we worry all the time about valuations, so that goes without saying. But the fact is that Dr. Reddy's had 2-3 things going for it beginning of the year, and when we raised it to a very large weight in our model portfolio, plus our top pick in the sector. The first was that it had a great valuation discount relative to the sector. Second was that the earning estimates were, they were not as volatile or not prone to downside risks like of the others. And third was that they were making certain long-term strategic investments into their R&D pipeline, etc., which we thought the street was underappreciating. So I think 2 out of these 3 arguments have played out, which gets reflected in some of the valuations. Dr. Reddy still continues to be a structural long-term pick, but it's something which we think is obviously not as compelling as it was beginning of the year. And the reason for that is that some of the risks now start getting underappreciated at 23, 24 times. A case in point being their Venezuelan exposure, which is now to the tune of $15 million. The fact that growth in FY14 also benefited reasonably from the contribution of Venezuela. So a couple of risks at current prices beginning to get completely discounted and underappreciated, but the long-term case for Dr. Reddy still exists.
Okay, long-term case for Dr. Reddy still exists. What about something like Sun Pharma, Anmol? We have seen so much play out over the last 3 or 4 months.
So we continue to have a counter-consensus sell rating on Sun Pharma, driven by the view that the synergy benefits from Ranbaxy are overstated relative to the stock price. We also think that because of 2 prime reasons. One, the supernormal pricing that you saw in certain drugs in the US, and second, remediation at Halol still being under process. The FY17 turnaround story is overstated. Valuations at current levels do not offer any comfort either. So we see no reason to change our negative stance on Sun Pharma. We know that we are pretty lonely saying that, but we think that Sun Pharma does consolidate here for a reasonably large period of time. We've seen stock move from 1200 to 800 and now bounce back. These part of rallies will continue to happen, but the 4 or 5 year structural bull run in Sun Pharma, in our view, is clearly over.
Okay, I heard you briefly mention Divi's Labs, but I just wanted your view on whether the risk reward is still favorable for Divi's, because that stock has seen a phenomenal run, and even in the quarter gone by, the profits were up almost 50%. So everything looks good, but is everything in the price already?
So quite a lot of it is in the price, so there's no disputing that fact. But I think what's important to also bear in mind is that the earnings estimate for FY17 for Divi's do pose upward risks. Currency depreciation being the primary driver of that. We also think that they could potentially benefit from traction in their custom synthesis business. As I pointed out earlier, this is not a stock which is under formal coverage, but predicated on the above 2 reasons. One, a reasonable benefit of currency depreciation, and second, traction in custom synthesis business and high capacity utilizations. There are upward risks to FY17 earning numbers. So we continue to be constructive on Divi's. Yes, valuations are a bit stretched, but they are not outlandish when you compare it with the rest of the sector.
Okay, the stock that divided the analyst community after the numbers was Cipla, Anmol. We had so many sell calls and so many buy calls, almost equal number. What's your call on the stock?
So Cipla is something which we are extremely constructive on. I know that the last quarter number had kind of mixed reception from the street, but the debate on Cipla is fairly simple. The last quarter was probably the best operational quarter you're going to see in a long period of time. So that goes without saying. That's not likely to be repeated, a point we concede. But the fact is that Cipla is going to be the highest earnings growth company in the large cap for the year. And that is the kind of performance which you can't take away from them, notwithstanding the fact that this quarter is unlikely to get repeated. Outside of Nexium, for which they benefited immensely, there are a couple of things going for them for the rest of the 3 quarters of the year. One is, as you move towards the second half of the year, you start seeing positive news on inhaler franchise come through. You also see traction in tender building up, and let's also bear in mind that Cipla is the only large cap which still has around 44-45% exposure to domestic market, which is a far more stable market and which is also seeing a growth rebound. So on multiple counts, we think that Cipla's earning estimates don't offer any meaningful downside risks. There are a lot of initiatives which demand investments, which might keep the margin structure volatile. But this being the best operational quarter as a dynamic is not something which is exclusive to Cipla. It is prevalent in a lot of other companies also. It's just that Cipla hasn't got benefit of doubt from the street this time, which will start coming as you see, improved operational performance in the remainder of the year, driven by Pulmicort AP supplies, a probable inhaler approval in the UK, and obviously tender wins in 2H.
All right, Anmol, point taken. Thanks so much for joining us today and giving us all your views on the sector and individual names. By the way, the market is back to the low point of the day, 83.67.